The hurdles facing the country's non-resource exporters just keep getting higher. The Australian dollar is hovering around levels seen against the US currency not seen for nearly 30 years. Many experts predict its run to continue, partly because of the return of the so-called carry trade. Here's Philip Lasker.
The world may be on edge as Japan struggles with its nuclear disaster, protests erupt in the Middle East and debt problems persist in Europe, but the Australian dollar has resumed its ascent.
There's several major factors behind the recent climb. The first one is the rebounding commodity prices that we've seen over the last week or so as confidence has returned about the continuation of global growth. On top of that, I think we're seeing a resumption of downwards pressure on the US dollar. And finally, we're starting to see a return of what is sometimes technically called the carry trade.
The carry trade strategy was in full swing before the global financial crisis struck. It's where investors borrowed very cheaply in Japanese yen at virtually zero interest rates to invest in currencies like the Australian dollar, where interest rates are much higher. Japanese authorities have responded to the earthquake by pumping more money into the system at zero interest rates, while the G7 central banks have stepped in to help the Bank of Japan prevent the yen from appreciating beyond 80 yen to the US dollar.
You don't want the currency that you're borrowing to get more expensive to buy back. And given that the Bank of Japan has put a line in the sand at around 80, we think that the yen FX carry trade could definitely get restarted. And that's an upside risk to our forecast for the Australian dollar.
Because much of that cheap and plentiful Japanese money is expected to find its way offshore.
If the FX carry trade gets moving again, it probably means higher asset prices. So financial asset prices, equities, commodities will rise in value. And the Australian dollar will get a double kick from that because we're seen as a risk currency, and also our currency strength is related to commodity prices.
It could be related to insurance companies bringing money home to pay for the rebuilding of Queensland after the floods and a lift in merger and acquisition activity.
And that has lifted the Australian dollar above where you would think it would be given the strength of our export prices and the difference between our interest rates and global interest rates.
But some think it should be quite a bit higher.
My view is that the Australian dollar by the end of the year, if not before, will hit 110 US cents. I think what's happened over the last 6 months or so is that we've unwound the aberration.
And the aberration, according to Shane Oliver, is the period since 1982 when the Australian dollar has traded below parity, because since 1900 the Aussie dollar has mostly been above parity. And the upheavals have, to some extent, played into Australia's hands. Rebuilding requires resources, while the threats to nuclear power and oil supplies just makes LNG more sought after.